In this video, I'd like to share a classic bearish setup, and I'm going to be focusing on this setup inside of the S&P 500. Now, the reason for that is, as of Friday's close, this setup has officially triggered inside of the S&P. So what I'm curious about, which I'll explore in this video, is historically, how has this setup performed anytime we've seen it come to life? And to do so, we'll look at various different time periods in history. I'll look at 2018, where we had that December 2018 sell-off. I'll look at 2007, 2008 time periods, the obvious one. We'll also find some other periods in between to find random selection choices to know every time the setup has presented itself, how has it actually ended up? Has it led to a nice sell-off, or have there been a lot more stop outs than not? And what can we do with that information to be better prepared this time around? So that's the gist of this video. Now, before we go into exploring those historical time periods, let me first walk through the setup. Now, there's two different pieces for this setup, and it's very easy to follow along. I think one of the easiest setups you might actually find. The first is we'd like to have a bearish trend established. The way we're going to determine trend is by using our market pulse indicator. This is a completely free indicator. You can download it for free using the link in the description box below, and it's a nice substitute for moving averages. It plots one of three colors on this line that's either red, gray, or green. For a bearish trend, we're looking for only a red or a gray line. And this is a fantastic alternative to moving averages because it just keeps things simple. You don't have to worry about, oh, is this moving average above this one? Or what happens if these are stacked bearishly, but the 50 is still above the 200? Things of that nature. It just gets rid of all of that complication and presents you trend in a very simple, easy to read format. Either the line is red, green, or gray. Use that to determine your trend and move on to step 2. Now, step 2 for us is our trigger condition, which is based off of the edge signals indicator. The edge signals is completely free for all Volatility Box members. You can find it in your welcome email. And if you don't have access to the edge signals indicator, you can use your favorite overbought, oversold confirmation, things like the RSI, stochastics, even something like the Fisher transformer indicator. The gist here that we're looking for is find me bearish trends, and inside of those trends, we're looking to short oversold bounces, which for us is determined using the edge signals or these red arrows. So that's the setup. Should be very easy to understand. Now let's move on to charts so I can show you not only what the current time period looks like, but also what has happened historically and get an idea of how effective the setup has been. Now, here's a chart of the S&P 500 futures. This is the ES futures. Let's go through the same two rules that we just covered. One was we'd like to see red or gray market pulse line. And here we can see that pretty easily. We have red, gray, and we see no green in recent history. So step 1 of our rules is met. Now, step 2 we were looking for was our edge signal confirmation, which as of Friday's close, you can see that red arrow right here. So we have that rule being met as well. So both conditions so far have presented themselves. Now the question is when to actually get in, if at all. And if so, what is that ideal price that we're looking at? Where should our stop be? And what is the average follow-through move that we're typically used to seeing? So let me start by first now going back to that 2018 time period where we had this setup present itself. That was November 2018 right here. So let's zoom in and study this time period a little bit more in detail. Now, first, we're looking for that bearish market pulse. So we have red right here to gray to red. And the first time we see that bearish edge signal is right here. So as of this moment, step 1 is met. We have an overall bearish market pulse. Step 2 is met where we have a bearish edge signal. So now let's take a look to see what ended up happening. Once we had that bearish edge signal, we had brief follow through right here. And let me actually get the trend line tool so we can talk percentages. So from the close of that candle to the very low, that was about a 2.17% decline. But that wasn't really all that much before then. We had a little bit of a retracement, then another edge signal, still another second bearish setup because we're still in a bearish market pulse. So this is setup number 2. From the close of this candle down to the low, that was another about 2.64%. After that signal, we had another retracement up. This time, that retracement went a little bit higher. Market pulse still never turned green. And then we had our third and then fourth edge signal confirmations. After the third one, a little bit of a small fight back from the buyers, which drastically failed, and then the sellers just took over. So after this, if we use our closing candle to the very low, the December 18 from the last edge signal was about 14.36%, and from our very first edge signal confirmation, that was about 15%. So along this entire time period, we had one signal, nice 2% move down lower, retracement, 2% move down lower, 2 point something, but we'll round down to 2. Then pull back to the market pulse, and then that third and fourth final signals, which led to that nicer break move down. So this gives you an idea that once we see the signal, there are still retracement opportunities. So if you miss it, you still have opportunities to buy, or rather short, pullbacks into the market pulse. And every time we have that confirmation, we've seen at least a little bit of a sell-off inside of the S&P. These two are a little bit smaller, but then led to that nicer final decline. However, if you use this as your entry, you did have to deal with a bit of heat here before that final move actually took place. So that's something to keep in mind as well. And from a bar perspective, from this close to that final close, that was about 16 bars, 21 calendar days, that actually took place of waiting in between that first signal to that final signal where the move actually went off. So keep in mind, patience is very much a key aspect of this setup, and quick profits if you're looking to just get in and out fairly quickly. Now, if I zoom out outside of this, let's now go back all the way to 2007, 2008, and get a gauge for what happened there. So this is now 2009. Keep going back a little bit further. So this is that 2007 time period. We'll start with 2007 where we had a false signal right here. So let's look at a false signal as well, just to mix it up. Bearish market pulse right here. So step 1 met. Bearish edge signal, step 2 met. And in terms of the actual follow through that we saw from the close of this candle down below, just about 1.3% before price reversed. And to me, this is a very clear stop out that 1.3% is nowhere near substantial for profit taking, especially with the stop outside of our previous pivot point. That did not lead to a substantial move. So let's keep following along now and see what happens. So this is as of September 2007. Now, if we keep coming forward here, our next setup comes right here, which is December 2007. Again, bearish market pulse, bearish edge signal. Once we have the actual edge signal, we have a little bit of a pause move down lower. We pull back to the market pulse. Market pulse even goes green, but doesn't really hold before we see that final sell-off activity come through. So yet again, a similar pattern of once we have the close, we have a retracement. We don't go above that previous pivot point. And after that, we get a flush move down lower. And in terms of the weight required before the move actually took place, about 10 bars in this case before we broke our entry price. Now, in terms of where that move actually ended up taking us through, so let's look at that. So from that close, if I zoomed out now, all the way down to the bottom, that was about a 54-ish% decline. And along the way, if we use that next pivot, about a 13% decline. Once we had that 13% decline, pull back to the market pulse, yet another edge signal confirmation. So this is the second setup, a brand new setup. We have an overall bearish market pulse, the trigger confirming a move away from there. Stop is outside of the pivot point. Again, a little bit of a pause move before we start to see price action start to get going. So that's the overall gist here. So this was 2007, 2008. Now let me also fast forward to 2011, which had some other examples as well. And actually, before we get there, here, let's look at this one too, June 2010. So June 2010, bearish market pulse, bearish edge signal confirmation. Another pause for a couple bars sideways before we see that ultimate flush move down from the closing price of the candle down to about the bottom, around a 6%-ish move of decline. No pullback to the market pulse this time. And no real pause either, just that 2 bars, so nothing like the 10 bar period that we're used to seeing. Now keep coming forward here, and this is September 2011, where we had the other setup that came into play, which I thought was fairly similar to some of the ones we've seen. Bearish market pulse, bearish edge signal confirmation leads to just a small decline down lower, so about 2.98% or 2 point something percent using the close. Then we have a pullback to the market pulse. Then we essentially build a nice little pivot point right here, have our second edge signal confirmation, fairly drastic sell-off, and that then leads to a nicer move down lower with 1 and 2 more entries along the way. So in most of these scenarios, what I think we're seeing here, which for those of you with access to the edge signals in the market pulse, you can go back and look at all these setups. But if I had to sum up the takeaways here, they would be the following. I'm looking for a bearish decline move down lower, but I'd like to mitigate as much of this risk as possible. So if we did get a little bit of a pause here, maybe 1, 2 bars, even a pullback to the market pulse, that to me is ideal. That's where we can reduce our risk involved. The stop where this trade essentially proves us wrong is above that 4,600 mark on the S&P 500 futures. For the downside target, you may be looking at things like a retest to previous levels. So we have that 4,300 mark, which is your nice level. And beyond that, 42.25. If we continue to keep seeing further move down lower, retracements back up to the market pulse while we still have a red market pulse confirmed with the same setup, a bearish edge signal, are ones that I'd be looking to short into. This is a little bit trickier given that this is still the first leg down after we've had a retracement, but to me, this is meeting the rules of essentially what's happened in the past, and there's a very clear defining point where we know we're wrong as well. It's not like this is a trade you have to hang on all the way back up to the previous highs. No, we have a place where we know we're wrong. We have an edge here with the edge signal confirmation. We're looking for a little bit of a pullback or at least some sort of a pause activity here. If we see 2 inside candles here, things of that nature, then that would be an early entry to try and play that first leg move down, and then look for retracements trying to short along the way. So hopefully this video helps to give you an idea of the setup I'm looking at, helps to give you several examples of the setup as well, historically, what has happened, along with the tools to go back and study this yourself for all of you with access to the market pulse and the edge signals indicator. Again, the market pulse is 100% free. I'll leave a link to that in the description box. The edge signals is free for all Volatility Box members. And if you don't have that, feel free to use your favorite overbought, oversold confirmation signal. All right, take care, everyone. Good luck trading, and we'll see you in the next update.